Hi, this is Randy Finney with Right Side of the Chart, and today is Monday, March 26, 2018. In this video, I wanted to take a look at some of the various commodities. I think 2018 will go down in history as a one of the buzzwords at least will be the term tactical asset allocation. I've talked about this quite a bit. The last several years has been one of the greatest and easiest buy and hold markets in history, comparable to that leading up to the dot-com bubble, where almost all equities rose. There was a tremendous shift towards indexing, meaning people buying index funds versus the old managed mutual funds and hedge funds. And that indexing is going to cut both ways when it starts to, when that trade starts to unwind. It's not going to be pretty. But now, whatever your thoughts are on the stock market, I'm not here to talk about the market right now. I am here to talk about commodities and asset allocation. Now, asset allocation is a buzzword. If you're not familiar with it, it's key to successful investing as well as trading. As a swing trader, I look at any opportunities on any investment vehicles. I don't care if they're, precious metals, commodities such as grains, stocks, of course, ETFs of, any sector or industry, and even bonds. So you have, your main asset classes are stocks, bonds, and commodities, and then you have some, alternatives like REITs, real estate, and some other things out there. So what I wanted to talk on today is commodities, and what we're looking at here is a chart. On the top, we have the Bloomberg Commodity Index, and I have what the Bloomberg Commodity Index is made up of here is down below. So you can see it's about 30% in energy, 22% in grains, 18% in industrial metals, 16% precious metals, 8% soft commodities, and 6% livestock. Just to show you, if you're not familiar with what those, some of those terms are, well, most energy, and this is actually straight from Bloomberg's site right here. This is the 2017 target weightings for that index. You can see down below here. Let me circle it for you, just to make this clear. And you can pause this video if you need to. Here's the 2018 target weights. They just recently came out with their target weights. So you can see energy, which is comprised of natural gas, various types of, Brent and WTI oil, gas, and diesel, will comprise about 30% of that index. Grains, which you can see them all here, will make up about 22%. Industrial metals, again, there's your industrial metals right there, 17.5. Precious metals, gold and silver, about 16%. And let's make sure I have to scroll up for you guys to get all of this, since I've had this video in landscape mode. And then wrapping it up. Oh, no, let me scroll up a little bit more here. There we go. All right, wrapping it up, where was I? Precious metals. And then we have the soft commodities, which are sugar, coffee, and cotton, coming in around 8%, and finally livestock. Now, the reason, I have and will continue to focus on individual commodities versus just a commodity, a broad-based commodity ETN, or any type of mutual fund. For example, believe, I'm not sure, you can probably invest in the Bloomberg Commodity Index and get all of these. But the problem with that, and I've covered this in videos in recent months, is all commodities are not created equal. Just like within the stock market, there's various sectors. I can be bullish on tech stocks yet bearish on utilities at the same time, or vice versa, and you'll see one sector going up, the other going down. Now, however, both those sectors are within the S&P 500. And so just as the S&P 500 is comprised of, well, in that case, there's 11 different sectors in the S&P 500, commodities, you have various commodities. Some have absolutely no relation to one another, and others actually have an inverse relationship. For example, just recently, in fact, since late last year and into this year, I've been persistently bullish on most of the grains. We've had JJG, which is a grain ETF that holds corn, soybean, and wheat, the big three. And we've also had some of these as individual trade ideas as well, both official and unofficial. And in stating that, when I was going over some of the analysis in recent months, I said I was bearish on cattle, for example, not only because the charts confirmed, but also if I was correct on this, as I was, that we're going to see the grains go up. Well, that's one of the biggest input to farmers or cattle farmers is cattle feed, and cattle feed is comprised of it has corn, soybean, wheat. Those are some of the inputs into feeding cattle. So therefore, um, a broad-based investment in commodities, you're having a lot of offsets there. And another example too is energy. You might not think of it this way, but energy is a huge component, a huge input to just about any sector, even including livestock, but more so precious metals. I talked about this, several times in the past, couple of years back when I started becoming really bullish on gold and silver because we had falling energy prices, and I said that would hit the bottom line. This isn't the 16th century anymore. Gold's not just laying around all over the ground everywhere in riverbeds and easy to pick up. No, nowadays it's getting more and more expensive. You have to go deeper in the ground, use these heavy earth moving machinery, equipment to extract gold and silver and other precious metals and even some industrial metals from the ground. So therefore, you have energy is one of the biggest inputs. And so when energy prices, oil and gas is falling, net net, of course there are other variables, but net net that's a benefit to the miners who then can operate, their equipment, machinery, which is very energy intensive, so it lowers their cost and therefore increases their profit margin. So enough said on that. I just want to make clear this is why I think, even within the commodities area, it will be a stock or sector or individual commodity picking market. I guess is the easiest way to say that. Okay, so back to the Bloomberg Commodity Index up top and the S&P 500 on the bottom. What I pointed this chart out in the past, and historically, even going to the left of this chart, this chart goes back to the early 2000s. There has been a very tight, positive, clear positive correlation between commodities as a whole and the stock market, meaning you can see the green arrows when commodities fall, the stock market was falling, and when the stock market was rallying, commodity prices were increasing as well. And that continued into the bear market, the 2007 to 2008 bear market in stocks. They stock market peaked right around the time commodities peaked. They peaked a little bit later, but give or take, we're talking decades here. Um, and you can see the general trends where the correlation was very, very well defined. You can even see this little dip here and a little dip there. Then all of a sudden, something changed. And changed in about mid 2011. And I have a theory. I haven't read or heard about this anywhere else, but my theory is, and I've stated this before, the Fed's grand experiment, this quantitative easing, several rounds of quantitative easing, zero interest rate policy. I expected, and I do believe there to be distortions in the financial markets. And like anything else, there's a lag time there. So it took a little while for that correlation to finally break. And so what happened is commodities then, as the stock market went on to rally, being fueled by the uber low money and quantitative easing, pumping so much money into the financial system, that money was finding its home in stocks. Rates went down to zero. People needed yield, and a big part of this, and part of the distortions I'm talking about is, there are pension funds, there are retirees out there. They depend on, well, pension funds need to be diversified. Number one, they can't have all their money in stocks. They cannot afford to take that much risk. They have to, diversify with different asset classes, and they also, like to invest in income investments, as do retirees and other people. So when the Fed, by bringing rates to zero, they did that to spur growth in the economy and, by their own words, to force money into stocks. They wanted to pump the stock market up to increase consumer confidence. How do you do that? By taking away the alternatives. When you take zero rates down to zero, meaning 1, 2, even 5-year CDs were paying under 1%, and Treasury bonds, safe money investments were yielding next to nothing. People had very few choices, if any, but to move into the stock market to buy dividend-paying stocks. So that's what juiced the returns there. And again, that was not by coincidence. That's one of the Fed's intentions was to buoy the stock market to increase consumer confidence, to get spending going, and everything else, yada yada yada. And what happened is commodities don't, it's a they don't pay income. There's no interest on commodities. You only buy commodities if you expect prices to go up. So therefore, and that's part of the reason probably why we've seen a pretty big bear market in commodities, because money was chasing yield, and yield was to be found in increasingly in stocks with dividends. So basically, that's what's happened. At some point, maybe this positive, the historical positive correlation will return. But all I can tell you is this: here's what stands out to me besides that disconnect from the, the like I said, the unintended consequences, if you will, of quantitative easing and everything else the Fed's done. But what stands out to me is from the peak right here, back in late 2008, down to the trough here in commodities on top. Again, this general commodity index looks like was that 2016. Commodities, the commodity index, Bloomberg Commodity Index, dropped 70%. That is a vicious bear market. We haven't seen a bear market like that in decades. If not, I don't know how far back I have to go on the chart to find out if we've even had a 70% bear market in commodities. Over that, roughly over the same time period, again, the stock market bottomed in March of 2009, a little bit after the commodities peaked, and so far have recently topped in January with that rally. Again, I don't know what's going to happen to the right, but we're going to try to get there and figure this out. Point being, the stock market, the S&P 500, has rallied 325%, while commodities have dropped 70. So, number one, there's a valuation case to be made here. Commodities, you know, do not go to zero. Stocks can and sometimes do go to zero. If a company is mismanaged, um, there's fraud, the industry changes, and yesteryear's big companies, it's Apple 10 years from now, 20 years from now probably won't be the world's largest, biggest company. In fact, it's safe to say you study any point in time, there's always leaders that some of yesteryear's leaders are either non-existent anymore, or they're well below where they used to be, when they're at the top of the ranks. It's just, things change over time. However, commodities are not going away. Yes, we're trying to move towards green energy, solar, wind, geothermal, all that, but we're still very reliant. Our world is very reliant on oil and gas, grains. The population of the world's only increasing. There's only going to be a higher and higher demand for grains. That's a given. And everything else here, industrial metals, precious metals, livestock, everything. So I think it's safe to say that, there is a floor. We don't know where that floor is, but there's that tangible value in the necessity for commodities. So from a valuation basis, especially, they're coming off one of the worst bear markets in history, with a 70% drop into the 2016 lows and starting to move higher now, with the stock market coming off one of the most extended, one of the longest stock markets in history, one of the most powerful advances, measured from lows to highs. So therefore, again, not saying take all your money, put it into commodities, but I think that's where, going forward for the next several years, I think we'll see a lot of good opportunities here, and I think it's safe to say, or at least my opinion, that commodities as a whole will probably outperform the stock market in the coming years as well. Starting with 2018. So let's do this. Let's just go through. If there's enough time, I'll look at some of the futures contracts. I want to go through. I have a watch list of commodity ETNs, and those are usually or they're always the preferred trading proxy on the site as official trade ideas. I do that because I'm aware that a lot of traders and investors out there either don't have the experience, the abilities, they don't have a futures account, or the capital required. Futures, although they're very leveraged and you can outlay a relatively small amount of money to buy a futures contract compared to what it represents due to the leverage. But that's a huge amount of exposure to the market. Most commodities you're exposing yourself 50 to maybe 100,000 or more, depends again on the commodity, of exposure to the market. And part of any good portfolio The buzzword I used early on is tactical asset allocation, moving around, making sure you're spread out, but it's also diversification. So diversification is just as important within your equity portion of your portfolio as it is overall with different asset classes. And again, if you're going to play commodities or trade commodities, invest in commodities, I should say, my suggestion would not be to pick one and put all your money into sugar or into wheat and let it ride, but to tactically allocate money a certain percentage of your portfolio, whether that's 10, 20, 30%, whatever your comfort level is in commodities. And then within there, let's say it's 30% you want to have at this point in time, you break it down. Where do I want to put that 30%? Right now, do I want to have exposure to oil and gas? I'm going to go over these various commodities here and give you my thoughts. Now, starting out, I had this chart up on JJG. This was an official trade idea that we had recently. And it will the company iPath that has JJG, SGG, and a couple others. They're retiring those. They're replacing those ETNs with other ones very similar. So JJG will soon be replaced by JJGB. In fact, I'm sorry. It actually JJGB, which is the iPath Grains ETN, has already been rolled out. But you can see from the candlesticks here, it's still very thinly traded because it's a new ETN. Over time, you will have some history on the chart. So right now, I'll look at JJG. It hasn't yet been delisted, but it will be delisted soon, meaning it'll only trade over the counter. So there's JJG. You can see that we've had, just it trades very well. These are the grains and represents corn, wheat, and soybeans. Has all three of those in there, and it actually looks good. So JJGB, even though we don't have a chart to go off yet, what I see here on this one is, we broke out the last official trade we had here. We hit the first target. We pulled back as we usually do off the first target, went up, hit the second target. We gapped up above the second target, so that was hit. And then we reversed, but we pulled back to support. This is a support level here. We overshot it by just a little bit, but the indicators look constructive. I can see the PPO starting to curl up here, still above the zero line. That looks good. So I would expect another thrust up on JJG, but again, my suggestion. I don't even think you can buy this one now. Interactive Brokers. I tried to buy SGG the other day. They wouldn't let me because it's going to stop trading soon. They blocked they're only limiting it to closing transactions. But you can buy JJGB. You'll just have to go off this chart until you can sort of get some price history going on the new one, JJGB. I wish they would have just made whatever change they would have and left the symbols alone. That would have made it a lot easier, but I'm sure they had their reasoning there. All right, so we'll go through a couple others here in no particular order. Well, why don't we do this? Since JJG is comprised of wheat, corn, and soybeans, let's look at wheat. Wheat, we've traded this one mostly long over the years. Hit. These must be official trades back here. You can see, so we hit the final target there, final target there. There was a potential long-term target we fell just shy of. So you can get some really nice rallies in wheat, as you can see we did here. This one may have been an unofficial trade most recently, but you can see it trades well to the technicals. There was a downtrend line. There was a divergent low. Somehow it dropped off here on the PPO. You had bullish divergence there. We broke out, back tested. Again, commodities are doing well and they're trading well to the technicals. So there was your breakout, back test, big move up. Now, where are we at today? Well, we've come full circle. This was a resistance level that I had before. It was just above the wedge. That's where we hit. We had a reaction. Then we broke out of it and rallied. Now we've come all the way back in wheat. WEAT is the ticker for this ETN, and we're at support. And trend indicators still look good. So wheat, in my opinion, offers an objective long entry, and for ultimately a swing up, and probably well above that previous reaction high. It's not going to be a straight shot up. And when I say objective, you take a shot at a long, you put a stop somewhat below. If you're targeting up there, you have an attractive risk reward. And again, I'm starting to, finally hear more and more buzz about institutions moving out. The stock market is very volatile now. Institutions, especially pension plans, they're reducing risk. They have to. The stock market hasn't been doing well. It's down year to date. Money's coming out of the high flying tech fund stocks. It's coming out of the index funds. It's going to find a home. Bonds are still, rates have come up a little, but they're not paying a whole lot. So I think this is going to be one of the homes for a lot of the money. And trust me, even though they're reeling back on the quantitative easing, there's still a lot of liquidity in the system, a lot of money sloshing around. This is corn. That was an official trade. We had a first target here that was hit, went up. This was a support line I had, so we went up to that next support line, reversed. And again, trend indicator looks okay, still looks bullish. I can actually add a support line there. So there's another one that looks, recently pulled back to support right here. You can see all these reactions. That's where that support line that I just added. And again, that one looks bullish going forward. And then what else? There was soybeans. That's the other component of JJG. So of course you could buy these individually, or you can buy, go with the JJGB now. You can't buy JJG anymore. Soybeans, I don't have a strong opinion, although this is a support zone. You can see here, former resistance zone. A lot of reactions there. We went up, hit this target here, this resistance level, pulled back, and again, I'd have to study the 60-minute charts, and if any of these stand out, if I do see an objective entry, I will add these as longs, as we added SGG today, or SGG, I'm sorry, Cane, C-A-N-E, which I'll get to in a second. So next up is cut. I recently shared in some videos. There's two timber ETNs, wood and cut. Now these invest in timber and forestry companies. They're not investing in random length lumber, which is the only commodity for wood. But same story. I mean, it's obviously the charts are very similar, and it's going to track that. And I've shared a chart of random length lumber recently, the futures contracts. There it is, divergent high. It's wedging up, starting to roll off there. Pretty strong negative divergence. So my expectation on this one is for a continued move down to this trend line. Maybe have one last reaction, and that will go. If we were to go straight down through, maybe a kickback rally here. Either way, however the minor squiggles will work out, and I'll have to zoom down to the 60-minute charts and everything else to look at that. This is what I expect going forward. So here's a commodity. Unlike others that I'm looking at, a lot of the grains and softs that are down near their 52-week or multi-year lows, this one has rallied. This has been to a large extent due to the hot housing market, a lot of demand for lumber. And as if the stock market continues to weaken, consumer confidence will weaken. The housing market will also soften. In addition to that, of course, rates have been going up, and that's a net negative for the housing market as well. So eventually, supply is going to catch up and then most likely overwhelm demand right now for lumber. So here's one that is on watch for an official short trade idea. And by all means, if you wanted to initiate a short position now, you put a stop somewhat above the recent highs, I think it's objective. UNG, this ETN doesn't do the best job of tracking. That's natural gas. I don't have a strong opinion right now, at least not on this chart. Coal, I mentioned this one a few months back with this divergent high. I was looking for downside in coal. This is the coal ETF. Probably still some more downside to come. I'll just stay away from that one. BAL, this is cotton. This one looks to be wedging up. It's in an uptrend. I don't see a reason to short at this point. It had a divergent high here. There was a shorting up. You can see the negative divergence that started to play out. My best guess, and again, I'm staying away from this one personally at this point in time. Maybe come in, touch its trend line once more. Maybe another zig or zag up within this wedge. Another divergent high again, and then finally break down. This is at multi-year highs, so that's some of those I'm staying away from. And I wouldn't stay away from a commodity just because it's at multi-year highs. Sometimes that's bullish, the trend is up. It's all what I see in the charts. So here's cow. Again, in recent videos, I did talked about being bullish on the grains and bearish on cow. Cow is the UBS livestock total return ETN, and And there it is. I think I had highlighted this support level here, well defined. You can see a lot of reactions off this support level here. We'll color it up for you so you can see what I'm talking about. That contained all the pullbacks on cow back here in late 2016, early 2017. It was tested again in mid to late 2017, and finally it gave way. So that's a pretty bearish technical event right there. This is just now broken down. May offer an objective short entry. Would have offered it on the breakdown. Now the next objective short entry, it's moved quite a bit away from that support level. And so now support, once broken, acts as resistance. So any kickback rally, even close to that level, I think would provide an objective entry for a swing down here to about the 1975-ish level. Joe, symbol JO, is the coffee ETN. This is on watch for an official long trade idea. You have some bullish divergence here. Oops, I used the wrong line there. Trying to grab a trend line here. So we have a potential bullish divergence. Need to see this PPO turn back up here, curl up. But you can see a pretty nice, well-defined downtrend line, and that gives us this bullish falling wedge pattern here, and a divergent low, like we had a divergent low back here. Again, it's simple. My trading style is somewhat simple. There's a little more that goes into it than just what I'm covering here on the charts and these divergences, but it's a wash, rinse, repeat scenario. You see these divergent lows, bullish falling wedge patterns, and you get the rallies. You can also trade it on the short side if you see divergent highs. But I'm waiting for the next break at this level, and I'm looking at coffee as a potential bottoming play. Not just these were swing trades within a larger bear market, and each one was quite profitable. But I think there's a good chance we can see a new uptrend in coffee because, again, I think 2018 will be the year of the commodities, and a lot of these ag commodities are the ones I'm looking at. So I already covered soybean, cane. This is an official trade idea on the site. Divergent low, bullish divergence, and I've also posted the charts on the future, so you can check that out on the site. Again, I put an update today on cane, so there's the price targets. Needs to show me something here. I held off after adding SGG as a trade shortly before the close. Then I came to learn right as I went to place the trade after putting that trade idea out. My trade was rejected, that SGG would be delisted. So I said we use Cane as the proxy. SGG, again, is from iPath. That's one of the ones that's being delisted, and they're replacing with SGGB, but you can see very thinly traded right now because it's a new ETN. So therefore, we're using Cane on this one, and I think it has a good shot eventually working its way up here at about that 990-ish level in the coming months. But we just don't have any signs of a reversal yet. However, I went ahead and added it today because what I've learned it's like a game of musical chairs here with these commodities. Once the momentum players, all of a sudden something triggers and they move fast. And if you're not in advance, you can get left out quickly. If you wait just a few days, you've missed out on a lot of these reversals. You've missed out on a big part of the move. So therefore, I personally and officially on the site have positioned, in advance of what I believe to be a reversal in Cane. And very often, I'll wait for a breakout of a downtrend line or some other type of, buy signal on it. All right. NIB, Cocoa. This was also an unofficial trade idea recently. I've been bullish on this one. In fact, somebody asked me the other day in the trading room if it looked toppy here with the PPO crossover. I said, no, I thought it had another thrust up, and it did. So it had this was a strong run. This was simply a period of consolidation. So, some of these commodities, they can run when the supply demand dynamics shift. This one's up, what is that, 50% in just 2.5 months or so. So you can have potentially explosive gains. And the bigger picture on this now is this, you know, Cocoa has been in a multi-year basing pattern here, about a year long, not multi-year, about a 1 year long basing pattern right here, and it finally broke out above the top of that basing pattern. See all the reactions here, reactions here. So that was a bullish breakout. And again, this one, because of this basing pattern, sure, it's not going to continue up forever. There's a long-term target zone that I have up here, but eventually I can see the possibility and the likelihood that Cocoa's in a new um, bull market, in the early stages of a new bull market, instead of just a bear market rally like the previous rallies were. DBA, this is one I've shared before. This is a one size fits all. If you don't want to have to try to actively manage various positions and you want one ETF that holds, here's the weightings as of March 2nd. You can see all the various commodities within there. Um, Again, and these are agricultural commodities. So here's one that's a decent play, X oil, where some of the commodity, all-inclusive commodity ETNs have oil, and I'm pretty bearish on oil. I'm going to wrap up here with my outlook for oil, but again, you're going to have some back and forth within here because, of course, like I said, you have cattle and hogs in there. But you also have wheat, corn, soybeans, and some other things that go into, the inputs to raise the livestock. So again, I'd rather trade the individual commodities personally. Okay, we'll wrap it up with oil. This is just one of several ETNs out there, and I'll share some charts on WTI, West Texas Intermediate crude. But what I'm looking at here is a major top in crude. I think it's going to coincide with weakness in the stock market. Crude's been rallying as it should have. It came out of a vicious bear market, and we were bullish and long towards the bottom, and several times throughout this rally, and long and short. This is something you can trade, and usually my preferred trading proxy is the energy stocks, XLE, XOP, XES. But what I can see is just a little more upside in crude. It could reverse any time now. It's almost made an equal high, and you can see that the indicators are lagging. This is negative divergence, so at best maybe a little more upside, and then a move down here to this trend line. And again, I'll have to align this chart with WTI and crude futures, but I think the outlook going forward for the next, let's just say, several months at plus for crude is bearish in my opinion. All right, we'll wrap it up there. This has been Randy Finney with Right Side of the Chart. Pretty long video, but just remember when you're watching these videos, just hit that setting icon on the video down on the bottom right hand. You can increase the playback speed, and that'll shorten the duration. But I just wanted to do a comprehensive outlook on commodities, and I think I did that here. Hope you enjoyed it.